when we were looking at working capital, I told you current assets are either in form of cash or are readily convertible to cash. While current liabilities are also while liabilities are also divided into two: current liabilities and long-term liabilities. Current liabilities are those that are due within a short time, like bank overdrafts, current expenses. Those are the bills that you are going to pay in a short while. While long-term liabilities are include bank loans and owner's equity. The liability is the longest life in a business is what the amount of money you yourself invested. That is what we call owner's equity. But you can also add retained profits. The profits that are reinvested in a business every time. Let me try to see whether I have a sample of a business balance sheet so that you can move. Sure, I do. So your balance sheet will look like this. I believe everybody can now read. It will have about 4 columns. One more item. Then it will have the beginning of year one and end of year one. Then end of year two. If the total cost exceeds the total revenue, you have not started generating profits. But the point at which the total revenue will surpass the total costs, then you are making profits. That is why I said the figures in the financial plan are figures that are telling a story. And it's important to note that you can present break-even graphically, showing both break-even quantity and break-even in Kenya shillings. And when you are calculating the break-even point, you show all the working. You show all the working for year one, for year two, for year three. So you take the respective fixed costs, divide by the respective contribution margin. It is as simple as that. Then we are just about to finish. We have the expected profitability ratios. If you'd want to know how a business is performing, we usually do this using what we call ratio analysis. We usually use ratio analysis to show this. And you can calculate so many different types of ratios in a business. But what we are interested in at this level are only those 5 ratios. Number one, the gross profit margin, which is calculated by getting gross profit divided by total sales multiplied by 100. So gross profit over total sales times 100. Then the net profit margin, which is calculated as net profit over total sales times 100. Then return on equity. This is simply answering the question. For every shilling of your own income is what we are referring to as equity. How much return are you getting out of it? And you do this by getting net profits before tax over owner's equity times 100. Or you can even do it net profit before tax times 100 over owner's equity. Whichever approach you take, it is going to give you the same answer. Then return on investment. This is now is based on total investment, equity plus any debt. Because in a business, I remember when somebody must have told you when you're running the source of business finance that investment is gotten from equity and debt. So for this one, to calculate, it is going to give you're going to use the approach net profit after tax plus interest, because the moment you take a loan, you must pay interest, over total investment times 100. And this is answering the question, for every shilling that you invested in that business, what was the return of every shilling that you invested? How many shillings? How many more shillings are you making? And these ratios are calculated for 3 years. Let me make an observation here. From my own experience, I've taught different classes, especially even the engineering classes. And there's a tendency to force things here. Because when you see, for example, these figures going beyond 100%, those especially in engineering, they start to get worried because they believe most of their calculations on efficiency or on returns never go beyond 100%. But in business, it is vice versa. The higher the ratios, like these profit margins, the better it is for the business. If you are trading and you make a profit of 300%, you are better off than somebody who is making a profit of 80%. So don't force anything. Last but not least, desired financing. This is a very straightforward figure because on one side, what money do you require and how much? What you desire is maybe to buy machinery, so much. To finance working capital, so much. To finance sundry expenses, so much. And any other expenses that you may have in your business. You add all these. So on one side, you are asking, how much money? What money do I desire? And what for? That is one side. But on the other side is how I will raise this money, or these finances. So you may say, personal savings, so much. Bank loan, so much. Asset disposal, so much. Total, so much. And in fact, for startup businesses, 5.9 and 5.10 should have the same values. They should have the same values. They should have the same values. Because you're simply asking the same question. How much money do I require? So much. How much money do I require and what for? I require so much money to purchase the following assets and finance the following needs. Where will I get this money? I will get it from the following sources: savings, bank loan, asset disposal, or donations. And that underlines the balance sheet equation where I said you should always have assets and liabilities balancing. So that is it. Any questions? That's the end of the financial plan. Any questions or clarifications? Grace Sungu, I need your name and number. Also, Brian, I need your name and number. Grace Simio, I need your name and number. I will propose you log out and log in immediately because I want to end the lesson. So log out and log in immediately so that you are captured by the system. And anybody else who has logged in, who has not logged in using name and number. This is extremely important. The other announcement that I have to make is that I've looked at some work for about 10 individuals, and they are all from diploma in IT. And I've given you the deadlines for submission of this work. By this time next week, everybody ought to have presented at least up to chapter 4. Keep me busy. Those who have submitted, I've looked at everything, not unless you submitted today after midday. Anything else that I had, I've sent it back to you. Yes. Also, Brian, I need your admission number. Don't log in using your telephone number. It is your admission number, please. So keep me busy. Keep me busy. Because next, I want to send you that work. So I want to create an email. I want to send this work to you. You have chapter 1 to 4 guidelines. Chapter 1 to 4 guidelines, do you have them? That's okay, Grace. Okay, Vanessa. Now, for those that have looked at your work, is there anything that was not clear? I can answer questions. Although you have a leeway of communicating with me because I have an email, you can always ask a question through email or through WhatsApp. Yes, Kelvin, that is a common mistake I'm seeing with some of you. What I mean by self-reference is that you involve yourselves too much. You keep on referring to yourself. I, my. Yet you are not writing a business plan about yourself. You're writing a business plan about a certain business. So when I tell you to avoid self-reference, I want you to remove yourself from it. Any other question? Now, because of the time element, I'm addressing Yvonne, you made, and especially yours was a very good one. You really understood. The only thing that I found out, you have a tendency, when you're trying to do it so well, you have a tendency to repeat, avoid repetitions. So just edit and move on. Because I must get these business plans. I'm very comfortable with some of you who have given me their work. It is only that they did not have a financial plan. And God willing, we can meet once more next week so that I'll explain about those other pages. Well, Felix, I told you that is exactly you. I told you are economical with points. You see, one thing you people must understand is that what I'm giving you are not questions. So those